Throughout history, certain investors have anticipated market downturns and positioned themselves to profit while most people suffer losses. In 1929, Joseph Kennedy began selling his stocks months before the market crash and profited by shorting securities as prices fell. Similarly, in 2008, Michael Burry identified the vulnerabilities in subprime mortgages and made hundreds of millions by betting against them. Now, in 2025, financial history appears to be repeating itself, following a familiar four-stage pattern that savvy investors consistently follow. This sequence is not based on luck or speculation. It's a systematic approach that relies on recognizing when markets are overvalued, anticipating corrections, and preparing strategically. Ordinary investors often hold stocks through a collapse and lose significant wealth, while experienced professionals exit at peak valuations, hedge against downside risk, and ultimately deploy capital when opportunities are at their greatest. The stages include exiting overvalued positions Stage 1, purchasing protection or insurance against market declines Stage 2, shorting specific vulnerable sectors or companies Stage 3, and finally, buying assets at discounted prices during maximum fear Stage 4. Stage 1 involves liquidating holdings 12 to 18 months before a market decline. Investors may not know the exact timing, but they recognize when asset prices are unsustainably high. In 1929, Joseph Kennedy systematically sold stocks as the market soared, aware that excessive leverage and margin debt made the market fragile. Other investors, like Bernard Baruch, who had experience from the panic of 1907, were also converting positions into cash. By September 1929, these investors had largely exited, weeks before Black Thursday marked the start of a historic crash. In 2008, the pattern was repeated by a new set of investors. Michael Burry, running his hedge fund, studied subprime mortgages in detail and realized that many borrowers could not sustain their loan payments. He used credit default swaps, essentially insurance against mortgage defaults, to position for the coming collapse. John Paulson similarly created a fund to bet against risky housing securities. Both investors endured months of losses and criticism while the housing market continued rising, understanding that their positions would only pay off once the system began failing. Fast forward to 2025, and the first stage is visible again. Major investors are systematically selling overvalued positions. Warren Buffett is holding an unprecedented $325 billion in cash, signaling caution. Jeff Bezos has sold billions in Amazon shares, and Mark Zuckerberg has similarly liquidated portions of Meta stock. Insider selling across corporate America has reached levels reminiscent of 2007, suggesting that those with the best access to company information are preparing for market adjustments. Indicators like the Buffett indicator, which measures total stock market capitalization against GDP, are well above historically safe levels, highlighting potential overvaluation. Stage 2 involves buying protective positions, volatility insurance, before market stress becomes apparent. Historically, this could involve shorting stocks or purchasing instruments that increase in value during a decline. In modern markets, these protections include put options, volatility index VIX options, or credit default swaps. The principle is to secure coverage when it is relatively inexpensive, anticipating that the cost will be far outweighed by potential returns during a downturn. In 1929, Kennedy and Baruch shorted stocks after exiting long positions, effectively buying insurance against the inevitable crash. Similarly, in 2008, Burry and Paulson paid premiums on credit default swaps, enduring losses until defaults triggered massive payouts. Today, evidence of Stage 2 activity is visible. Institutions are purchasing puts, VIX options, and credit default swaps tied to commercial mortgages and corporate debt. Volatility indicators, like the put-call ratio, show elevated hedging activity, suggesting that professional investors are protecting against declines in key sectors. Credit default swap prices for commercial real estate-backed securities have surged, signaling expectations of upcoming stress. Hedge fund managers, including those like Bill Amann, have publicly referenced strategies designed to hedge against potential disruptions in commercial real estate and regional banking, indicating that Stage 2 protections are already being implemented. Stage 3, which often occurs 3 to 6 months before a downturn, focuses on shorting specific sectors or companies identified as most vulnerable. This stage requires precision and research. It's not a general bet against the entire market. Historical examples include targeted short positions in subprime mortgage securities or particular financial institutions. The objective is to position for maximum gains when the anticipated vulnerabilities begin to unfold. By understanding these stages and observing current market behaviors, investors can recognize where the smart money is moving, even if they cannot replicate the exact trades. The patterns are consistent, and awareness of these cycles provides an advantage in preparing for potential market adjustments while maintaining a safe and policy-compliant approach to financial commentary. In 2008, the biggest profits came from Stage 3, where investors weren't just betting against the market as a whole, they were targeting specific sectors and securities that were most vulnerable. Michael Burry and John Paulson, for instance, identified particular mortgage bonds most likely to fail. Burry focused on subprime loans in states like Florida, California, Arizona, and Nevada, especially adjustable-rate mortgages set to reset at levels borrowers couldn't afford. By shorting those precise bonds, he ensured that, when defaults occurred, his positions would pay out substantially. Paulson applied a similar strategy, not only shorting risky mortgage securities but also targeting financial institutions most exposed to subprime debt such as Lehman Brothers and Bear Stearns, before their imminent failures were apparent to the broader market. While analysts were recommending these stocks, the hedge fund managers recognized the hidden risks, positioning themselves to profit as the institutions collapsed. Today, in 2025, a similar strategy is unfolding. The sectors showing the highest vulnerability are commercial real estate and regional banks. Many office buildings sit half-empty due to permanent changes in work habits, and mortgages that were originally manageable at low rates are now far more expensive to refinance. When building owners cannot meet their obligations, defaults will rise, creating losses for lenders, especially regional banks heavily exposed to commercial real estate. Hedge funds are already building short positions in commercial mortgage-backed securities, betting that these loans will fail. Credit default swap prices on these securities have surged, signaling that sophisticated investors anticipate large-scale defaults. Regional banks face similar pressures. The failures of banks like Silicon Valley Bank and Signature Bank in 2023 demonstrated how quickly problems can escalate. These banks were heavily invested in long-term bonds and commercial loans that lost value as interest rates rose. With commercial real estate forming a significant part of their loan books, regional banks are particularly exposed. Hedge funds are monitoring these institutions closely, taking short positions in those most vulnerable to default. This strategy is not about creating panic. It is about recognizing and preparing for risk before it becomes obvious to the public. The final stage, Stage 4, occurs when fear is at its peak, and the smart money deploys capital to acquire undervalued assets at fire sale prices. Historically, this has produced enormous wealth. In 1929, investors like Joseph Kennedy used this strategy to buy stocks, real estate, and businesses at depressed prices, multiplying their fortunes while most others lost everything. In 2008, Warren Buffett famously invested in distressed financial institutions such as Goldman Sachs and Bank of America, securing favorable terms and high returns while the market was engulfed in panic. Looking ahead to 2025 and 2026, Stage 4 will likely unfold in a similar manner. When commercial real estate defaults cascade and regional banks begin failing, markets may drop 50% or more. The smart money, armed with cash reserves built during Stage 1 and protected by strategies in Stage 2 and 3, will step in to buy quality assets at dramatically reduced prices. Private equity firms and investment giants are already holding record amounts of capital, ready to purchase distressed properties, corporate debt, and other undervalued investments once panic peaks. While not everyone can execute all 4 stages personally, understanding this cycle provides a significant advantage. Stage 3 is currently in motion. Smart money is taking strategic positions, anticipating the eventual collapse. By recognizing these patterns, investors can prepare for Stage 4, maintaining liquidity, considering protective measures such as options for insurance, and identifying fundamentally strong companies to acquire when prices reach historic lows. History shows this cycle repeats, and those who understand it can preserve and grow wealth while others may face losses.